Hey everyone, welcome back to Corporate Decoder. Today, Allspring Funds Trust just filed their N-CSRS report, and I'm seeing one critical detail about their underlying investments that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is reporting on the period ending the 31st of March 2026, and within that filing, I'm seeing some very interesting shifts in how they are holding their assets. Alright, so we are looking at a filing from Allspring Funds Trust, which is a registered investment company. This particular report covers the semi-annual period from the 1st of October 2025 to the 31st of March 2026. The company is highlighting 10 of its series, including things like the Allspring Common Stock Fund and the Allspring Index Asset Allocation Fund. The main focus here seems to be on the managed account CoreBuilder Shares Series SP. It is interesting to note that for this particular series, the manager has contractually committed to cover all ordinary operating expenses. This means for the past 6 months, investors in this series would have paid zero in direct operating costs. Without this commitment, the costs would have been higher. A common strategy to attract assets early on. When we dive into what the fund actually invested in, things get pretty interesting. The largest chunk of their long-term investments, about 29.3%, is in asset-backed securities. Following that, we see corporate bonds and notes making up 24.1%. Then there are non-agency mortgage-backed securities at 19.2%. And US Treasury Securities at 12.3%. It is a mix that really leans into debt instruments with a notable portion in asset-backed and mortgage-backed securities. Think of asset-backed securities as bundles of loans like car loans or credit card debt that are sold off to investors. Looking at the top 10 holdings, a significant portion is in US Treasury Notes. For example, US Treasury Notes with a 3.50% interest rate maturing in February 2029 represent 6.3% of the net assets. Another holding is US Treasury Notes at 3.63% maturing in August 2027, making up 2.7%. This signals a strong emphasis on US government debt as a core holding, which is pretty standard for a fund focused on income and stability. Now, let's talk about fund costs for a hypothetical $10,000 investment in the managed account CoreBuilder Shares Series SP. The cost for the past 6 months was $0. That is right, 0%. This is directly due to that manager's commitment to absorb all ordinary operating expenses. This is a big deal for investors looking to keep more of their returns. Diving into the key fund statistics, the total net assets are listed at $27,273,947. The number of portfolio holdings is 176, and the portfolio turnover rate is 89%. This turnover rate suggests they are actively managing the portfolio, buying and selling within the year. Shifting gears slightly, we see another fund here, the Diversified Capital Builder Fund, specifically class of shares ticker ECBAX for this fund. The cost for a hypothetical $10,000 investment over the past 6 months would have been $57, which translates to 1.06% on an annualized basis. This is clearly different from the zero cost we saw earlier. When we examine the portfolio composition for this Diversified Capital Builder Fund, it is heavily weighted towards common stocks at 87%. Corporate bonds and notes make up 12.5%, and Yankee corporate bonds and notes account for the remaining 0.5%. This tells us it is primarily an equity-focused fund. The top 10 holdings list for this fund features some familiar tech names. Micron Technology Inc. is at the top with 4.7% of net assets. Advanced Micro Devices Inc. follows at 3.8%, and Amphenol Corp. Class A at 3.6%. It is a clear focus on well-known technology and semiconductor companies. Next up, we have the Diversified Income Builder Fund. Class of shares, ticker XAX for this fund. The costs on a $10,000 investment over 6 months come in at $42, or 0.84% annualized. This is lower than the class of shares of the Capital Builder Fund, but still reflects operating expenses. The portfolio composition here is quite different. Corporate bonds and notes are the biggest component at 35.5%. Common stocks follow at 31.1%. Then we see investment companies at 11.3% and Yankee corporate bonds and notes at 10.5%. This fund is clearly designed for income generation with a heavy reliance on fixed income assets. The top 10 holdings reflect this income focus. We see eShares ETFs like the 3 to 7 year Treasury Bond ETF at 3.6% and the 1 to 3 year Treasury Bond ETF at 3.2%. This confirms the fund's strategy of using treasury bonds for stability and income. Intriguingly, there are also some common stocks in the top 10 like Nvidia Corp. And Apple Inc., which suggests a hybrid approach, aiming for income with some growth potential. Moving on, we have the Mid Cap Growth Fund, class of shares, ticker SYNAX. The costs here for a $10,000 investment are $54, or 1.13% annualized. This is a bit higher, reflecting the typical expense structure for growth-oriented funds. Sector allocation shows a significant focus on industrials at 33.6%. Healthcare is next at 17.4%, followed by information technology at 16.1%. This indicates a lean towards core economic sectors with a good mix of growth areas. In the top 10 holdings, we see Vertiv Holdings Company Class A at 5.0%, Quanta Services Inc. at 4.2%, and Cloudflare Inc. Class A at 3.5%. These are primarily industrial and technology names fitting with the sector allocation. Now let's look at the Mid-Cap Growth Fund Administrator Class, ticker WFDDX for this fund. The 6-month costs on a $10,000 investment would be $55, or 1.14% annualized. This is in the higher range, typical for funds focused on growth in smaller to mid-cap companies. Sector allocation here is very similar to the Mid-Cap Growth Fund we just discussed. Industrials lead the pack at 34.8%, followed by healthcare at 24.0% and information technology at 18.6%. The strategy appears to be consistent across these specific growth-oriented funds. The top 10 holdings are also quite concentrated in the industrial space, with Comfort Systems USA Inc. At 3.4%, Carpenter Technology Corp. At 2.5%, and RBC Bearings Inc. at 2.3%. This reinforces the fund's emphasis on industrial and manufacturing companies. Finally, we have the Common Stock Fund, class of shares, ticker SACS for this fund. The costs on a $10,000 investment over 6 months would be $60, or 1.20% annualized. This is the highest expense ratio we've seen among the class of shares, likely reflecting a more active or specialized investment strategy. Looking at sector allocation, industrials is the largest at 26.9%. Information technology follows at 17.4%, and financials at 15.1%. It is a more diversified approach compared to some of the growth funds, but still leans heavily into core economic sectors. The top 10 holdings are led by on Semiconductor Corp. At 2.2%, Kirby Corp. At 1.9%, and Marvel Technology Inc. At 1.8%. These are solid companies, but the overall concentration in the top 10 is spread out more than some of the other funds. When we look at the "What did the fund invest in?" section for the managed account CoreBuilder Shares Series B, we see an interesting breakdown again. Asset-backed securities make up 29.3%. Corporate bonds and notes are at 24.1%. Non-agency mortgage-backed securities are at 19.2%. And US Treasury Securities round out the top holdings at 12.3%. This is a portfolio that clearly prioritizes fixed income and securitized debt. The presence of non-agency mortgage-backed securities, for example, means they're investing in mortgages that don't have government guarantees, which can carry slightly higher risk, but also potentially higher returns. Across a few of these funds, like the Diversified Capital Builder Fund, we see a total net asset figure of $1,936,932,064. The number of portfolio holdings is listed as 99, and the portfolio turnover rate is at 15%. A low turnover rate like 15% suggests a more buy, and hold strategy rather than frequent trading, which can be tax efficient for investors. For that Diversified Capital Builder Fund, the portfolio is overwhelmingly invested in common stocks at 87%. This is followed by corporate bonds and notes at 12.5%, and then a small slice of Yankee corporate bonds and notes at 0.5%. This tells us the primary driver of returns will be the stock market performance. The top 10 holdings for Diversified Capital Builder Fund are dominated by tech. We see Micron Technology Inc. at 4.7%, Advanced Micro Devices Inc. at 3.8%, and Amphenol Corp. Class A at 3.6%. These are all significant players in the semiconductor and technology space, indicating a strong bet on this sector's continued growth. Let's look at the Diversified Income Builder Fund. Class of shares, ticker XAX. The costs here for a hypothetical $10,000 investment over 6 months are $42, or 0.84% annualized. This is a reasonable cost for an income-focused fund. The portfolio composition for this fund offers a clear picture of its income strategy. Corporate bonds and notes are the largest holding at 35.5%, followed by common stocks at 31.1%. Then come investment companies at 11.3% and Yankee corporate bonds and notes at 10.5%. This diversification across different types of debt instruments is key to generating steady income. When we look at the top 10 holdings for the Diversified Income Builder Fund, we see a heavy concentration in Issuer's Treasury Bond ETFs. The 3 to 7 year ETF is 3.6% and the 1 to 3 year ETF is 3.2%. This aligns perfectly with an income focus. leveraging us Treasury debt for its perceived safety and predictable returns. Looking at the portfolio allocation for the Income Plus Fund, class of shares, we see agency securities at 24.5%, corporate bonds and notes at 23.5%, and foreign government bonds at 17.8%. This fund is clearly spread across us in international fixed income, aiming for broad diversification in its income generation strategy. The presence of foreign government bonds, like those from Italy and Brazil, suggests an attempt to capture yield opportunities globally. The top 10 holdings for the Income Plus Fund are dominated by mortgage-backed securities and government debt. GNMA securities are prominent, like the 5.50% coupon maturing in April 2056, representing 8.8% of net assets along with FNMA securities. This is classic income fund territory, focusing on instruments known for their yield. This report is a semi-annual shareholder report for Allspring Index Asset Allocation Fund, detailing investment information as of the 31st of March 2026. This document aims to provide shareholders with crucial updates on the fund's financial standing and investment strategy. For the Index Asset Allocation Fund, the allocation shows a neutral target for stock funds at 60.0%, with an effective allocation of 61.0%. Bond funds have a neutral allocation of 40.0% and an effective allocation of 39.0%. This indicates the fund is closely tracking its target asset allocation, leaning slightly more into stocks than bonds at this particular reporting period. This slight overweight in stocks might be a strategic move based on market outlook. The top 10 holdings for this index asset allocation fund are very telling of its underlying index strategy. Nvidia Corp leads with 4.5%, followed by Apple Inc. at 4.0% and Microsoft Corp at 2.9%. It's heavily weighted towards major technology companies, mirroring the performance of a broad market index. The presence of US Treasury notes also shows a degree of risk management within the broader allocation. Let's transition to what these funds cost investors. For the SMID Cap Growth Fund, class of shares, a hypothetical $10,000 investment over 6 months would incur $57 in costs, translating to 1.14% annualized. This is in line with what we expect for actively managed growth funds, where the management and operational expenses are generally higher. Looking at the sector allocation for SMID Cap Growth Fund, industrials is the largest at 34.8%, healthcare follows at 24.0%, and information technology at 18.6%. This focus on industrials suggests an investment strategy that may favor companies involved in infrastructure, manufacturing, and industrial services, which can be a strong indicator of economic activity. The top 10 holdings for the SMID Cap Growth Fund are quite concentrated in industrial companies. Comfort Systems USA Inc. leads at 3.4%, followed by Carpenter Technology Corp. at 2.5% and RBC Bearings Inc. at 2.3%. This reinforces the fund's strategy of identifying growth opportunities within the industrial sector. Now, let's examine the SMID Cap Growth Fund, Class R6 shares, ticker WFDRX. The cost here for a hypothetical $10,000 investment over 6 months are $38, equating to 0.79% annualized. This is a lower cost, often seen in R6 share classes, which are typically designed for retirement plans and institutional investors, implying economies of scale. The sector allocation remains consistent for this SMID Cap Growth Fund across its classes. Industrials at 34.8% holds the top spot, followed by healthcare at 24.0% and information technology at 18.6%. This consistency suggests a unified investment strategy across different share classes, aiming for similar growth exposure. The top 10 holdings are also consistent with the class of shares and administrator class led by Comfort Systems USA Inc. at 3.4%, Carpenter Technology Corp. at 2.5%, and RBC Bearings Inc. at 2.3%. This repetition across share classes for top holdings indicates a strong conviction in these particular industrial names by the fund managers. We're looking at the Common Stock Fund, class of shares, ticker SAX. The costs here for a $10,000 investment over 6 months are $60, or 1.20% annualized. This is on the higher side, which is not uncommon for actively managed funds that aim for specific stock selection. The sector allocation for the Common Stock Fund shows industrials as the largest at 26.9%. Information technology is second at 17.4%, and financials third at 15.1%. This is a well-balanced approach, blending cyclical and growth sectors. The top 10 holdings for the Common Stock Fund are led by on semiconductor Semiconductor Corp. At 2.2%, Kirby Corp. At 1.9%, and Marvel Technology Inc. at 1.8%. These are solid companies, but the diversity in sectors represented in the top 10 holdings is lower compared to some other funds. For the Income Plus Fund class of shares, the portfolio allocation shows agency securities at 24.5%, corporate bonds and notes at 23.5%, and foreign government bonds at 17.8%. This fund is clearly focused on fixed income across different geographies and types of issuers. Aiming for a diversified income stream, Skrogma 5.50%, the 21st of April 2056 Twin Pool. Looking at the top 10 holdings for Income Plus Fund, Class A, we see a lot of government-backed mortgage securities and foreign bonds. GNMA securities like the 5.50% coupon maturing in 2056 make up 8.8% of net assets alongside FNMA securities. This is a textbook income-focused approach prioritizing yield from reliable sources. Lastly, let's check the Income Plus Fund institutional class. Ticker WS Inc. The costs here for a $10,000 investment over 6 months are just $20 or 0.39% annualized. This is significantly lower than the retail share classes, reflecting the reduced distribution and servicing fees associated with institutional shares. It is a clear cost advantage for larger investors. The top 10 holdings in the institutional class are identical to the class of shares, confirming the underlying investment strategy remains consistent. GNMA securities are prominent with the 5.50% coupon note at 8.8%. This shows that even with lower expense ratios, the core income generating strategy remains the same for both investor types. Scroll portfolio of investments, the 31st of March 2026, unaudited agency securities, 0.33% Ford and Scroll. Now let's do a deeper dive into the portfolio of investments for the managed account CoreBuilder Shares Series SP. We see agency securities making up a small fraction at 0.33%. The largest holdings are in asset-backed securities at 27.99%, followed by corporate bonds and notes at 23.02%. Then comes non-agency mortgage-backed securities at 18.39%. And US Treasury Securities at 11.77%. This confirms the strong emphasis on debt instruments I noticed earlier, with a significant portion also in US Treasuries for stability. Within the asset-backed securities, we see a variety of trusts and LLCs. For example, ACRC LLC Series 2025 FL3 Class A, which is a 144 security, has an interest rate tied to US SOFR plus 1.31%, maturing in August 2042. The 144 designation means it is a private offering that can be resolved to qualified institutional buyers, which reduces liquidity but can offer different risk-reward profiles. The underlying assets here are likely diversified to spread risk. Looking at the statement of assets and liabilities for the managed account CoreBuilder Shares Series SP, the total net assets are reported as $27,273,947. The number of shares outstanding is 1369854, giving a net asset value per S-share of $19.91. This is a moderately sized fund, and it is interesting to see the manager covering all operating expenses, which is a significant driver of that 0% cost you saw in the highlights. The statement of operations shows a net investment income of $677,039. Expenses are technically listed but then fully offset by fee waivers and expense reimbursements, resulting in a net expense of $0. This is a direct consequence of the manager's commitment to absorb ordinary operating expenses. The real story here is the net realized and unrealized gains or losses on investments, which came in at a loss of $243,516. This indicates that while costs were $0 for the investor, the underlying investments themselves saw a slight dip in value during this period. Let's revisit the portfolio composition for the Allspring Diversified Capital Builder Fund, which we saw was heavily weighted towards common stocks. This fund has 87% in common stocks, 12.5% in corporate bonds and notes, and 0.5% in Yankee corporate bonds and notes. The top holdings are tech names like Micron Technology Inc. and Advanced Micro Devices Inc., clearly positioning this fund for growth. For the Allspring Diversified Capital Builder Fund, the total net assets are a substantial $1,936,932,064. The number of portfolio holdings is 99, and the portfolio turnover rate is a relatively low 15%. This low turnover suggests a long-term investment approach, rather than active day-to-day trading, which can be beneficial from a cost and tax perspective for investors. The top 10 holdings are indeed dominated by tech giants. Micron Technology Inc. sits at 4.7%, Advanced Micro Devices Inc. at 3.8%, and Amphenol Corp. Classa captures 3.6%. This concentration in a few key players is a hallmark of many growth funds, betting on their continued market leadership and innovation. Now let's look at the Allspring Diversified Income Builder Fund. Classa shares, ticker XAX, the cost for a $10,000 investment here is $42, or 0.84% annualized. This aligns with the fund's stated goal of providing income, as such funds often hold a mix of bonds and dividend, paying stocks, which can come with slightly different expense structures. The portfolio composition for this fund shows a strong emphasis on fixed income. Corporate bonds and notes are the largest segment at 35.5%, followed by common stocks at 31.1%, investment companies at 11.3%, and Yankee corporate bonds and notes at 10.5% make up the rest. This is a diversified approach within fixed income, aiming to capture income from various sources. The top 10 holdings are dominated by iShares ETFs focusing on Treasury bonds, which are typically considered safe havens and provide predictable income. The iShares 3 to 7 year Treasury bond ETF is 3.6%, and the 1 to 3 year Treasury bond ETF is 3.2%. However, it is interesting to also see Nvidia Corp. and Apple Inc. in the top 10, suggesting the fund isn't purely income focused, but also seeks some capital appreciation. We're now looking at the mid-cap growth fund class of shares, ticker SYNAX, for a $10,000 investment over 6 months. The cost of $54 or 1.13% annualized. This is a typical expense ratio for actively managed mid-cap growth strategies, where research and active stock selection drive the costs. Sector allocation is heavily tilted towards industrials at 33.6%, suggesting a focus on companies driving economic infrastructure and manufacturing. Healthcare follows at 17.4%, and information technology at 16.1%, indicating a blend of cyclical and growth-oriented sectors. In the top 10 holdings, Vertiv Holdings Company Class A is the largest at 5.0%, Quanta Services Inc. is at 4.2%, and Cloudflare Inc. Class A is at 3.5%. These selections align with the sector focus, particularly in technology and industrials, where these companies are recognized leaders. Next, let's check out the SMID Cap Growth Fund. Administrator class, ticker WFMDX for this share class. The costs for a hypothetical $10,000 investment over 6 months are $53, or 1.05% annualized. This is a common expense for administrator class shares, often found in retirement plans. The sector allocation here is very similar to others we've seen, with industrials leading at 34.8%, followed by healthcare at 24.0%, and information technology at 18.6%. This consistency across funds suggests a broad strategy within the Allspring suite, focusing on established economic drivers in growth areas. The top 10 holdings are heavily concentrated in the industrial sector. Comfort Systems USA Inc. at 3.4%, Carpenter Technology Corp. at 2.5%, and RBC Bearings Inc. at 2.3% highlight this focus. These company selections indicate a strategy to capture growth from companies that are essential to infrastructure and industrial development. We're now at the SMID Cap Growth Fund class of shares, ticker WFDAX for this share class. The costs on a $10,000 investment over 6 months come in at $57, or 1.18% annualized. This is on the higher end, which aligns with an active growth strategy, targeting smaller and mid-sized companies for potential outsized returns. The sector allocation for this fund is identical to the other SMID-cap growth classes we reviewed. Industrials is the largest sector at 34.8%, with healthcare at 24.0% and information technology at 18.6% following. This consistent weighting across sectors implies a unified approach to navigating growth opportunities within this market capitalization range. The top 10 holdings are also mirroring what we saw in the other SMID-cap growth share classes, Comfort Systems USA Inc. at 3.4%, Carpenter Technology Corp. at 2.5%, and RBC Bearings Inc. at 2.3%. This repetition underscores the fund manager's confidence in these specific industrial and manufacturing companies as key growth drivers. Finally, let's look at the Common Stock Fund. Class of shares, ticker SCARX, the cost for a hypothetical $10,000 investment over 6 months are $41, or 0.83% annualized. This expense ratio is moderate and falls within the typical range for actively managed equity funds. The sector allocation for this common stock fund is led by industrials at 26.9%, with information technology at 17.4%, and financials at 15.1%. This diversified approach aims to capture broad market growth while maintaining a significant allocation to sectors that are typically linked to economic expansion. In the top 10 holdings on Semiconductor Corp is listed at 2.2%, Kirby Corp at 1.9%, and Marvell Technology Inc. at 1.8%. These are significant holdings, but the overall concentration seems more spread out than in some of the more specialized growth funds, suggesting a broader market approach within common stocks. This document is a semi-annual shareholder report for the Income Plus Fund, covering the period from the 1st of October 2025 to the 31st of March 2026. These reports are crucial for shareholders to understand the fund's year-to-date performance and strategic direction. Let's look at the Income Plus Fund. Class of shares, ticker WSCX for this fund. The costs on a $10,000 investment over 6 months are $36, or 0.71% annualized. This is a relatively low expense ratio, especially for a fund that likely holds a mix of assets to generate income. The top 10 holdings for the Income Plus Fund are heavily skewed towards fixed income and mortgage-backed securities. We see GNMA Securities and FNMA Securities being the largest holdings. GNMA, for instance, which is backed by the full faith and credit of the US government, represents 8.8% of net assets in its 5.50% coupon note. This confirms the fund's primary objective is income generation. Finally, for the Income Plus Fund, let's check out the institutional class. Ticker WS Inc.'s the costs here are incredibly low, $20 on $10,000 investment, or 0.39% annualized. This is a highly competitive expense ratio, reflecting the benefits of institutional share classes, which typically have higher investment minimums but lower ongoing fees. The top 10 holdings for the institutional class are identical to the class of shares, which is expected as they invest in the same underlying portfolio. We still see GNMA and FNMA securities at the top, emphasizing the fund's commitment to income generation through dependable fixed income investments. For the Index Asset Allocation Fund, the portfolio composition is broken down into stock funds at 61.0% effective allocation and bond funds at 39.0%. This is a very straightforward, balanced approach, likely mirroring a major market index. The neutral allocation is 60% stocks and 40% bonds, showing they are sticking closely to that target. The top 10 holdings in the Index Asset Allocation Fund are dominated by major tech names. Nvidia Corp leads at 4.5%, followed by Apple Inc. at 4.0% and Microsoft Corp. at 2.9%. The inclusion of US Treasury Notes in the top 10 also suggests a degree of diversification and risk management, even within an index-focused strategy. The fund isn't just chasing performance, it is also building in some stability. Let's look at the Index Asset Allocation Fund. Class C shares, ticker WFX. The costs here for a $10,000 investment are $90, or 1.82% annualized. This Class C share class typically carries a higher expense ratio due to ongoing distribution and servicing fees. The allocation breakdown is consistent across the different share classes of the Index Asset Allocation Fund. We see stock funds at 61.0% effective allocation and bond funds at 39.0%. This consistency highlights that the underlying investment strategy is the same, with differences primarily in the fee structure for different investor types. Once again, the top 10 holdings are dominated by the big tech names. Nvidia Corp is leading at 4.5%, followed by Apple Inc. at 4.0% and Microsoft Corp. at 2.9%. This reinforces that the fund is indeed tracking a broad market index where these companies have significant weight. For the Opportunity Fund, Class R6 shares, ticker YFRX, the portfolio composition is heavily weighted towards information technology at 30.2%. Industrials follow at 14.6% and financials at 14.0%. This is a growth-oriented fund, and the heavy tech allocation points towards a strategy focused on companies with high growth potential. The top holdings for the Opportunity Fund are predominantly large cap tech companies. Amazon.com Inc. is the largest holding at 6.5%, followed by Alphabet Inc., Class C at 6.0% and Microsoft Corp. at 5.7%. This clearly indicates a strategy that believes in the continued dominance and growth of these major technology players. Lastly, we examine the Opportunity Fund, institutional class. Ticker WFNX, the costs here are $36 for a hypothetical $10,000 investment, or 0.75% annualized. This is a competitive expense ratio for an actively managed growth fund. especially for institutional investors who often require detailed reporting and specialized services. The sector allocation for the Opportunity Fund is heavily skewed towards information technology at 30.2%. Industrials and financials come next, both at 14.0%, followed by communication services at 11.6%. This confirms a strong tilt towards technology, which often implies a focus on innovation and growth potential. The top 10 holdings are, as we saw before, led by Amazon.com Inc. At 6.5%, Alphabet Inc., Class C at 6.0%, and Microsoft Corp. at 5.7%. The conviction in these large cap technology names is evident across different share classes, suggesting a core belief in their ongoing market leadership. Looking at the portfolio composition for the Special Mid-Cap Value Fund, class of shares, we see a more balanced allocation. Industrials are the largest sector at 22.8%, followed by information technology at 13.9% and financials at 11.3%. This fund appears to be taking a value approach, possibly looking for undervalued companies across various sectors, rather than concentrating heavily in just one or two. The top 10 holdings for the Special Mid-Cap Value Fund don't immediately scream growth. We see American Electric Power Company Inc. at 3.4%, Keysight Technologies Inc. at 3.4%, and LabCorp Holdings Inc. at 3.2%. This list leans towards more established companies, possibly with steady dividends or stable earnings, fitting a value investment style. Let's look at the Special Mid-Cap Value Fund, Class R6 shares, ticker WFPRX. The costs here for a $10,000 investment over 6 months are $36, or 0.70% annualized. This is a very low expense ratio, typically found in R6 share classes which are designed for retirement plans and institutional investors, indicating a cost effective option for those channels. The sector allocation for the Special Mid-Cap Value Fund is consistent across its share classes. Industrials lead at 22.8%, followed by information technology at 13.9%, and financials at 11.3%. This spread across sectors suggests a strategy that isn't overly reliant on any single industry for its value opportunities. The top 10 holdings remain the same for this class as well. American Electric Power Company Inc. is at 3.4%, Keysight Technologies Inc. at 3.4%, and LabCorp Holdings Inc. at 3.2%. This consistency in holdings across different share classes underlines the fund's core value strategy and its selection of established, potentially undervalued companies. For each of these funds, the total net assets seem to be the same across different share classes, like the Special Mid-Cap Value Fund, where it is $12,838,100,163. This figure reflects the overall size of the fund and its ability to attract substantial investor capital, which can sometimes lead to better liquidity for its holdings. For the Allspring Common Stock Fund, class of shares, the portfolio composition is primarily common stocks at 87.0%. Then there are corporate bonds and notes at 12.5%, and Yankee corporate bonds and notes at 0.5%. This is a very straightforward equity-focused fund, common in the retail space. Looking at the top 10 holdings for the Common Stock Fund, we again see tech names like Micron Technology Inc. at 4.7% and Advanced Micro Devices Inc. at 3.8%. This suggests that even a general common stock fund can have a significant tilt towards growth sectors depending on the index it tracks or the manager's discretion. The Index Asset Allocation Fund's portfolio composition strategy is straightforward: 60% in stock funds and 40% in bond funds for neutral allocation. Effective allocation shows 61% in stock funds and 39% in bond funds. This slight overweight in stocks might be a tactical decision based on market conditions or a slight drift from the neutral stance. The top 10 holdings are very familiar names: Nvidia Corp at 4.5%, Apple Inc. at 4.0%, and Microsoft Corp at 2.9%. These are the titans of the tech world, and their significant weight in the portfolio is expected for an index tracking fund that likely emphasizes large cap stocks. For the Opportunity Fund, class of shares, the portfolio composition shows a hefty 30.2% in information technology. Industrials follow at 14.6% and financials at 14.0%. This heavy tech weighting suggests a growth-oriented strategy targeting companies with high innovation and market potential. The top holdings are truly the giants of the digital age: Amazon.com Inc. at 6.5%, Alphabet Inc. Class C at 6.0%, and Microsoft Corp. at 5.7%. This shows a strong conviction in large cap technology and growth stocks as the primary drivers of return for this fund. Finally, let's look at the Special Mid Cap Value Fund Administrator Class, ticker WFMDX. The costs here for a $10,000 investment over 6 months are $53 or 1.05% annualized. This is a moderate expense ratio for an actively managed value fund, especially one focusing on mid-cap companies. The sector allocation for this fund shows industrials at 22.8% as the largest slice. Information technology is next at 13.9% and financials at 11.3%. This diversified approach, while still leaning into core sectors, suggests a search for value opportunities across a broader range of industries, not just concentrated in one. The top 10 holdings are quite diverse, reflecting a value strategy that might look beyond just tech. American Electric Power Company Inc. A utility is the top holding at 3.4%. Keysight Technologies Inc. An industrial tech company is tied at 3.4%, and LabCorp Holdings Inc. In healthcare, at 3.2%, this mix shows a hunt for value across different market segments. For the Special Mid-Cap Value Fund, class of shares, ticker WFPAX, the costs for a hypothetical $10,000 investment over 6 months are $57 or 1.12% annualized. This expense ratio is typical for an actively managed value fund, balancing the cost of research and management with the potential for alpha generation. The sector allocation is consistent across the share classes, with industrials at 22.8% leading, information technology at 13.9%, and financials at 11.3% follow. This reinforces that the fund's core investment philosophy of seeking undervalued companies across different sectors is applied uniformly. The top 10 holdings remain consistent. American Electric Power Company Inc. at 3.4%, Keysight Technologies Inc. at 3.4%, and LabCorp Holdings Inc. at 3.2%. This repetition signifies the fund manager's strong belief in these specific value plays as key contributors to the fund's strategy. Let's look at the Special Mid-Cap Value Fund, Class R6 shares, ticker WFPRX. The costs here for a $10,000 investment over 6 months are $36 or 0.70% annualized. This R6 share class offers a lower expense ratio, commonly targeting retirement plan assets where cost efficiency is a priority. The sector allocation is unchanged. Industrials at 22.8%, information technology at 13.9%, and financials at 11.3%. The value strategy continues to be applied broadly across these sectors, seeking opportunities wherever they may present themselves in the mid-cap space. The top 10 holdings are consistent. American Electric Power Company Inc. at 3.4%, Keysight Technologies Inc. at 3.4%, and LabCorp Holdings Inc. at 3.2%. This adherence to the same core holdings across different share classes shows a disciplined approach to the fund's value mandate. Finally, we look at the Special Mid-Cap Value Fund Institutional Class, ticker WFMX. The costs here are $41 for a $10,000 investment, or 0.80% annualized. This institutional share class typically has a slightly higher expense ratio than R6, but is still competitive, reflecting the services offered to larger investors. The sector allocation stays the same. Industrials at 22.8%, information technology at 13.9%, and financials at 11.3%. The value strategy is clearly executed across the board, regardless of the share class, focusing on the fundamental approach to identifying undervalued mid-cap companies. The top 10 holdings remain consistent. American Electric Power Company Inc. at 3.4%, Keysight Technologies Inc. at 3.4%, and LabCorp Holdings Inc. at 3.2%. This consistency really drives home the point that the underlying investment thesis for the fund is unwavering across its different investor facing share classes. The total net assets for the Special Mid-Cap Value Fund across all its classes are a massive $12,838,100,163. This fund is enormous, boasting 67 portfolio holdings with a turnover rate of 18%. A fund this size requires significant operational infrastructure, and the fees reflect that. Scroll over all these filings reveal a common theme of active management with varying expense ratios depending on the share class, and a clear focus on specific investment styles like growth or value or broad index tracking, the real estate or mortgage-backed securities in some funds, and the heavy tech weighting in others. Highlight the diverse strategies employed by Allspring Funds Trust to meet different investor needs. The zero-cost fund is a standout, but that is a feature often seen for a limited time. The takeaway is always to check that expense ratio and understand the underlying strategy before investing. Alright, that is my take. Stay decoded. If you found this analysis valuable, hitting that like button really helps, and subscribe for more deep dives. The research tools I actually use are linked in the description. They help keep this channel going.